Hello, my name is Crystal Dahl, and I'm the Online Communications Manager here at Meritas. I would like to welcome and thank each of you for joining us on today's webinar. For those of you that are new to Meritas, Meritas is an established global alliance of closely connected yet independent law firms that each offer a full range of high-quality specialized legal services. We were built upon a rigorous system for monitoring and enhancing the quality of our member firms and have been connecting clients with carefully qualified business legal expertise in over 250 markets around the world since 1990. Meritas capability webinars are regularly presented by Meritas members. Before we get started, I would like to quickly go over a few housekeeping items. Meritas offers the ability to listen to our webinars through your computer speakers, but if any time you have difficulty hearing the presentation, you may call into the associated telephone line instead. All the phone lines will be muted. If you experience technical difficulties with your phone, please press *0 to connect with a support technician. Since you will be muted, if you have a question, please ask via the questions module. You may need to expand the section by clicking on the gray bar that says questions to actually type in that question. Lastly, in the next few days, I will distribute a copy of the presentation, a recording of this webinar, as well as everyone's contact details. With that, Chris, are you ready to get started?
I am, thank you. So thank you everyone for joining us. Presently, we have about 35 people with us, and we actually have 80 who have signed up. So really appreciate you taking out the time to spend time with us. And I also, before we get started, I hope everything is going as well as possible in your life and world. We've all had our contexts and practices and families uprooted and changed, and we're all facing a certain amount of stress. And some of us are facing a lot more than others. And hopefully COVID-19 has been mostly a stay-at-home exercise stressor for you, and it hasn't come closer than that. But I wish you well. So today we have the presenters we have today are 3 practitioners from around the globe. And this is what Meritas does so well, brings people from around the globe together who have similar practices or dissimilar practices to support one another. From Tel Aviv and GKH, we have Itai Shea. From Milwaukee, we have Peter Faust and O'Neill Cannon, and Jonathan Pollan of Howard Kennedy is with us from London, England. And each of these practitioners, while they have different focuses, is well-grounded in M&A. And the thought today is that each of them will do a short presentation, 5 minutes or so, about an issue that they think is particularly relevant in the COVID-19 environment. We'll go to each of them, let them speak for a few minutes. And then afterwards, hopefully we'll get questions. And I really would encourage everyone to send in questions, and we'll send those questions to the panelists and hopefully have a fairly lively dialogue amongst the panelists. And real quickly, before we go to the panelists, I just want to thank Crystal for putting this together. A lot of work on her part. Also, Dawn Icarella, the US and Canada Regional Director, and Quentin Val, the European Regional Director of Meritas. Both Quentin and Dawn and Crystal have all done so much to support this community, the global M&A and private equity community, and appreciate all the efforts that they've done for us over the years. They really have. It's been years. And it's a lot of fun as this group grows and becomes more robust. And speaking of robust, Itai, if you would kick us off, it'd be great. I'll turn it over to you.
Thanks, Chris. So thank you, Chris. Thanks to Meritas. Thanks to my fellow. It's lovely to participate in this, and I hope this will be useful for everyone and fun and constructive. So I need my 5-6 minutes to kind of give a broad overview of what we're seeing in the M&A market in Israel during these kind of really crazy times. So generally speaking, you know, Israel is considered the startup nation. Tech is kind of the real leader in our exports activity from Israel. So it's kind of what we're all looking at in terms of how we measure, we gauge success here. Our Jewish mothers, Jewish grandmothers are all looking at how we sell. If our entrepreneurs will sell their companies in the US, will float them in the US on NASDAQ, on the New York Stock Exchange, and kind of less so, you kind of see less companies being built organically and kind of taken to a huge national kind of size capacity of company in Israel. So you're likely to less see the Alibabas or the Googles or the Facebooks in Israel, and more likely to see startup companies growing for shelf lives of about 5 to 8 years before they're sold off, hopefully sold off, usually to US corporations. For this is again, we're a small country, we're secluded, there's about 8 million people population here, and so we're very good on R&D and innovation, but less strong on infrastructure for growing these companies in Israel. So the Corona crisis has kind of really reignited this whole debate that we have in the ecosystem here in Israel as to whether we should be selling off companies quickly or growing them domestically. And now with the companies funding being depleted and VC slightly less active, this has become a real issue. So just a few numbers, that I've collected with that, which I thought might be interesting to kind of to flesh it out a bit. In Israel, we have representation of 360 multinational companies with R&D centers, kind of in more or less in Tel Aviv. Amazon, Microsoft, Google, all those all have presences in Israel. They usually started out by buying up some startup company and kind of grew organically in Israel. 55% of our exports are focused on all computer or tech related services. In 2017, the size, the quantity, value of exported services reached $17 billion, which placed us 7th in the world in export of tech. 40% of the population, the employable population, is in the high-tech industry. GDP in the high-tech area is double traditional industries, and so you can see that the tech here is pretty strong. So 2019 was a record year in Israel for VC investment in Israel. First quarter of this, now we're getting to the Corona. First quarter of this year was the highest in recorded history of VC investment in Israel. And then April arrived and it all dropped. There were only 17 recorded financing deals in Israel, which is about a 40 to 50% decline in VC investment. And what it means for companies that have started their sales in that are based in Israel, they were either looking at reducing manpower, trying to raise more funds, or looking at M&A. So what we saw was the deals that started prior to the Corona crisis did continue and get finalized during the period of March, April, May, mostly without reopening terms. However, deals that started post the onset of the crisis, in March or April, we saw deal terms becoming much more onerous on the sellers and much more protective, aggressive, and at lower valuations. Dollar shekel exchange rates in Israel during this period mostly worked for our startup companies because the financings are usually done in dollars and they keep the dollars in their bank accounts. So that's worked pretty well for us. There's one regulatory body in Israel that provides funding, government funding to the tech industry, the Innovation Authority. they've been pretty helpful in providing grants to companies, but most especially in Corona-related tech. Sectors that have particularly been hit in Israel, as you can imagine, the tourist industry, the travel tech, HR tech, but other sectors that have been thriving include gaming, and there's been some nice M&A activity in that area, and financing, digital health, educational technologies have all been quite exciting. And a couple of, just to kind of color it out with a couple of nice deals that we've seen in the last 2 months. NetApp purchased a startup in Israel called Spot for $400 million. National Instruments acquired Optimal Plus. It's an Israeli startup that grew in Israel for $365 million. Intel, and this is the deal that we were involved with, Intel acquired MoveIt, which is a transportation app, for $900 million. That was a very nice deal that happened last month. Hellman & Friedman, this is the largest cyber-related acquisition in Israel. They acquired Checkmarks, which was a cyber startup, from Inside Capital for more than $1 billion. So it was a huge M&A. Financing rounds have also it's been a mixed bag. We've seen Insight Partners, which is a US capital fund, very active in Israel, making an investment for $40 million here last month. And then on the flip, there's obviously the distressed M&A that we'll be discussing a little bit more in the during the session. So with that, I will hand it over to Jonathan.
Jonathan, please.
Yes?
Jonathan, thank you.
Jonathan, go ahead.
Always fun unmuting. First, can I say thanks a lot to Itai and to my fellow panelists as well, and to all of you today for participating. It's an interesting discussion that I hope that we're going to be having. So I started from the perspective of looking at a very old Yiddish adage, which is "Man tracht und Gott lacht," which means man plans and God laughs. So despite all our most careful planning, the road of life is completely unpredictable. No one would have thought that COVID-19 was coming prior to December of last year. No one except maybe Bill Gates in 2015 and a few 100,000 scientists around the globe. No one really realized how much of an indiscriminate, merciless and deadly disruptor this virus would be across the world, not only physically, with sadly the number of deaths, but also economically, with the potential for the greatest depression since the global economy saw the Wall Street crash in 1929, and in the UK's case, since 1706 and the War of the Spanish Succession. Edelman's, a PR agency, stated in early May that at this point in time, both the short term and the long term are rife with uncertainty. No one truly knows that what the macro effects of COVID-19 will be. So that leaves a wide open debate for us today. We've been seeing a completely different market in the UK for mergers and acquisitions, and actual activity levels had already been hit substantially over the last 18 to 24 months as a result of other uncertainties caused by Brexit, the lack of a viable majority in Parliament, government change, and the underlying slowdown in the global economy. The pandemic has merely exacerbated this slowdown, and particularly as the UK is now more of a service industry than one based on manufacturing. So the immediate impact on our landscape of the virus was that deals which were progressing immediately prior to lockdown stopped moving. And in some of those where signing had happened, but closing was still to occur, buyers have been looking at the outstanding conditions to closing and seeking ways in which they can argue a supervening event to terminate the contract via the common law principle of frustration, or utilizing express material adverse change or force majeure clauses. However, Those clauses are generally uncommon currently in private M&A in the UK. And perhaps that's somewhere, it's a space that we should be watching on future deals. Buyers have been reconsidering the representations and warranties and trying in some cases to establish whether there were fundamental material breaches in the period between signing and closing, and whether they could use those as justification to terminate the contract or leverage to renegotiate the consideration. And on a few of the deals in which we've been involved, there's been quite a bit of movement on the price, both in absolute terms and in structure. One deal which we signed on 1st January 2020 has not closed as planned in March of this year due to regulatory approval delays. The parties still decided to progress the transaction, but with a completely revised consideration structure. There's no acceptance of buyer equity. There's a greater focus on earn-out and deferred payments post-closing, and the risk has definitely shifted from the buyer to the sellers, but the deal is still moving forward. We've also seen in some of our deals that they've been signed and closed, buyers reevaluating the representations and warranties a lot more closely than they would otherwise have done previously. Buyers are considering whether a breach can be argued either to delay or defer payment of deferred or earn-out consideration, or just to try to create leverage for themselves in that regard. So as always, cash is king, and its preservation is similarly key for the companies. The UK is no different from the rest of the world in the sense that the major parts of the economy which have been impacted by COVID-19 and are really suffering comprise automotive, aerospace, travel, retail, leisure, and casual dining. I believe that we'll be facing a huge wave or tsunami of insolvent sales, which will take place probably after the beginning of September of this year, as we move towards the next major cash call for businesses here in the UK. And with the September quarter day rent payments, and as companies are weaned off the various governmental support schemes, including the coronavirus job retention or furlough scheme here in the UK. The so-called value or opportunity funds are gearing up to make hay while the sun of insolvency is shining. Significant dry powder or investment capital awaits with our clients, Gordon Brothers and Hilco, heading the charge in the UK. And as far as the solvent focus in the UK is concerned, companies which are more resilient have innovative IT solutions, just as the ones that ITI has been discussing, such as video conferencing, and have enhanced a move to digitalization, or are involved in the crisis in some ways, such as healthcare, pharma, logistics, have all been business as usual targets, and exceptionally, valuations in those areas have held up. Clearly, office space, retail and leisure and residential properties have all seen value adjustments in the last couple of months. Conglomerates are looking to streamline their operations and in some cases either to reduce or localize the supply chains. And environmental and social impact commitments are also now future key drivers for M&A, both here in the UK and certainly on a global basis. In summary, new deals are taking more time, more diligence, more focus on major contracts and any governmental support packages, more protection in terms of contractual provisions, more focus on capital requirements, and therefore, in all our cases, if we're lawyers, added costs. Ultimately, the real driver for activity is confidence. And as the watchwords in England have turned from stay home to stay alert, that caution, which has put the economy in the UK into isolation and stasis, now needs to be turned back on. So we need to look for something positive each day. And even if some days you have to look even harder. Thanks, Chris.
I apologize, I'm muted. Thank you, Jonathan. I got to remember to turn. I got to remember to turn myself back on. Peter, if you would follow up, that'd be terrific.
Thank you. Thank you, Jonathan. The story here in the U.S. is not dissimilar from what you just heard in Israel and the UK. Deal flow here had been so good for so long. It really was an incredible run. We knew it had to come to an end, maybe even surprised that it hadn't come to an happen sooner. But this was not the end we sort of expected. Not surprisingly, deal activity is down significantly year to date. In preparing for this, I've talked to colleagues, other attorneys, investment bankers, private equity firms, traditional bankers. I think you get a slightly different view and assessment depending on perspective and the people you're talking to and with. Private equity firms may have a different snapshot than strategic buyers, and lower middle market deals under 50 million, for example, with two private companies have a different outlook and different view than larger deals with public buyer. The overall numbers are bleak right now. Number of deals year to date in the U.S. is, I think, down, according to some estimates, 40% from last year and 60% in dollar amounts. More larger deals stalled because of that. I mean, it explains the differences in those percentages, but April numbers are telling. CIBC reported that the volume in April was 50% less than last year and 90% less than April of 2019 in deal values. And the April deal volume was the lowest since December of 1996. And the true effect of the pandemic hasn't been reflected yet in the deal numbers, because obviously at the start of the year, January was strong, February started to see some effects, and it's just been accelerating since then. But we really aren't going to see the true effect until we get the quarter two numbers in. But not everyone is struggling. There are some winners. You look at the NASDAQ exchange last week at its record high. Maybe 10%, 20% of the companies are thriving. Industries like technology, e-commerce, food suppliers, cleaning products, maybe work from home products. Others are hit very, very hard. Maybe retail, obviously auto, travel, and leisure. There's a strong middle section that's in kind of a wait and see moment. How is this going to shake out? Especially after, as you guys mentioned, some of the stimulus funds or loans from the government are applied and no longer available. What is going to be the true new normal for these companies? I think we're still in a wait and see approach right now with a lot of these companies. I do think that the gap though between the haves and the have-nots has widened in these times. Those who thrive will see an increase, not a decrease in multiples. They'll have this badge of honor that they've been able to survive in the worst times, and there won't be a lot of inventory of those type of companies, and there will be significant demand. So even though what we say generally, I think is going to apply to deals, there will be a strong subset that will do quite well and is doing quite well. In the lower middle market, if I were to put into one sentence what I've seen, what I expect to continue to see for a good portion of the year is that M&A deals are going to take longer to close, be more complicated, more expensive, and with more buyer-friendly terms and conditions. Some of that's pretty common sense, but that's what we're seeing. That's what we're going to continue to see. I think that in terms of the cost being driven up, a lot of it has to do with due diligence is going to be more involved on both sides, and more negotiations on type of agreements, and whether it's rollovers, earnouts, seller notes, and those all add some complications going forward. I do think though that the one thing that I've seen, I think we're going to continue to see, is that the parties in deal transactions are adapting to different roles. And for example, I think private equity firms are now more likely than before to offer convertible debts. Maybe some are taking more of a Warren Buffett approach, willing to consider minority purchases when they were not before. Maybe even as far as amending their organizational documents to permit that. As mentioned earlier by panelists, players, investment bankers, and others are no longer ignoring distressed companies. We're looking at leading transactions to buy or sell companies in bankruptcy or the state equivalent, what we call here in Wisconsin receivership. We're going to see more of that. These deals might have been beneath them a few months ago. And in doing these deals, you have to understand a whole new set of risk allocation. You don't have the same reps and warranties, more on an as-is basis. Due diligence is important. I like, though, that how a lot of the firms, investment banking firms, others refer to these as not distressed companies, but special opportunities, which is a great euphemism. Lawyers, too, are being advised, and we are as well. We have a strong creditors' rights practice, and we see deals that way. But be more familiar with deals in these types of situations, because I agree we're going to see even more of them. Unfortunately, there will be a strong inventory of these deals later in the year. I do think that the roles of buyers and sellers have changed under these circumstances. I think fewer deals in which sellers walk away from the deal with no stake in the future performance of the target. Contingent purchase price, seller financing, rollover required investments, by the buyer, make these relationships more of a partnership. And as a result, if they're not already doing so, I think sellers are going to do more due diligence on buyers than they have in the past, and we'll need to do that. We need to do so with the increase of these other terms, including earnouts and so forth. Now, that being said, I do see life in the market in the past few weeks. We had a lot of deals that were put on hold when the coronavirus really started to take effect. They didn't die, they were just put on hold and they stalled. A few continued, but those that stalled are coming back. Really activity. I think I'm seeing more deal flow, new deals being introduced, looking for potential buyers now as well. So I'm encouraged with what we've seen in the last few weeks, and I'm hopeful that will continue. I also think we're going to have a strong year and strong 2021. Of course, that could change. If the situations here with coronavirus changes in a way that people aren't expecting, and that's always possible. I do think you're going to see a lot of clients putting books together, pitch books together this summer, maybe going to market out in the fall and trying to close year end or early next year. So hopefully there'll be a strong rebound. But that's sort of the take that I've seen. I think everyone has a little different viewpoint on it, but that's mine.
Thank you, Peter. Much appreciated. We're starting to get questions in from people participating. Michael Locke has a question that I'll pass along a little bit. I'd like to start, though, on pricing. Jonathan, you mentioned that buyer confidence is key, and obviously that's very, very important. But the flip side of that is sellers have to want to be able to sell in what's increasingly becoming a buyer's market, right? So we have sellers who had expectations until quite recently of higher multiples and higher price. We probably have financing sources that are retrenching, both on the debt side and the equity side. What are you seeing in pricing? And I'll put this to, why don't we start with Jonathan? But I would like to hear what anyone has to say about pricing, because I suspect it's going to take some time to work its way down, right? And I suspect there's going to be a fair amount of variability from sellers on pricing and what they're willing to take, and structure addresses some of those issues. But I think it'd be a great place to start if we want to cross all three panelists about what they're seeing on pricing and whether prices are truly starting to move down. Jonathan, maybe you want to kick us off?
Thanks. Yeah, thanks, Chris. I want to just pick up on one point that Pete actually made, because I think Pete made a very good point about the pricing. Pricing values have adjusted, and they've adjusted also in different ways. So where you're saying that the level of price has come off a bit in certain markets, and it has definitely. If you look at the property prices at the moment in the UK, there has been a drop off, probably around about 5% at least, if not slightly more. You can do it by looking at the values on the stock markets, which have been coming off, going back up, coming down again when people have been talking about a second lockdown. That has an immediate impact on how you value the companies, what multiples you're going to be getting. Pete's point, though, was that the sellers themselves, who are going to be doing more due diligence on the buyers themselves to ensure that they are comfortable where they've got the sort of partnership type deals that Pete's explaining, there's going to be more of. There's going to be more due diligence going the other way, and there's going to be more reliance on the values, so a value shift between the two. So we have seen prices drop, certainly on the real estate related deals. We've seen a little coming off on some of the service deals that we're doing. There's one company which provides corporate services on a global basis, which is being acquired, and that the price has come off by only %, so it's only 2 to 3% overall. But I think the major hit is going to be retail, is going to be in leisure as well, where you have seen values dropping like stones, because obviously with lockdown, people's capital is sucked in. They've still got the underlying rent to pay. They may have deferred certain payments, whether it be to the Inland Revenue or to the local authorities by way of their rates, their business rates. But those monies are still going to be payable some stage down the line. So those have definitely dropped in value.
Ty, would you like to speak to this, or Peter? Yeah.
Yeah, sure. So in Israel, we're definitely seeing a hit on the prices. I think on I actually have a recorded statistic from the last couple of months. We've seen a drop in valuations, which range between 10 to 40%, and kind of with a median of around 25% drop, which is a big, which is very significant. Some of it is kind of compensated through deal structures where we see more kind of feeding into earnouts and founders kind of enjoying more of that kind of the pricing, the consideration coming in later stage. But it's definitely gone down, mostly in tech. Real estate and other sectors are less relevant here, so I can't really speak to that. Pete?
But I think just before Pete, sorry, Itai, they've dropped between 10 and 40%. But that drop, I think we're now looking at that as well. Similar scenarios here, but people are seeing rebounds. So you can see the immediate impact is quite visceral if you're looking at it right now. But I think if you're looking a little further down the road, some of these are going to start to come back up again.
Peter, is there anything else you want to talk about pricing? Yeah,
just quickly, I think in the US, the pricing has been relatively steady. I mean, it did, but not as much as maybe you would expect. And I think the number that we talked in a month from now or 2 months, the number will reflect something more severe. I would say though that in all cash deals, it's really a bigger drop in the pricing. And what I think you're seeing is a shift in buyers trying to be able to say they're maintaining the integrity of a valuation that was in place months ago by shifting more of the purchase price to contingent payments, especially earnouts, which isn't really the same as saying it's the same value because there's a contingency to it, but it allows them to say, if it's a relatively easy earnout to satisfy, that it is the same. We just want to make sure we have some security and confirmation. So I think I've seen that approach used a lot. So those prices haven't dropped as much yet. They could, but in the end of the day, they could. The earnouts aren't met. But I've seen, and I do think if we have this conversation, like I said, 30 or 60 days, you'll see a bigger drop than we've seen so far. Just not all the numbers have been reflected yet.
And by the way, my experience is very similar to Peter's. I think the pricing and multiple valuations are coming down more slowly, and they're being addressed with structure. And I agree with Peter. It's got a ways to go because of anchoring. I have personally been experiencing, at least in the lower mid-market and the mid-market, particularly in the lower mid-market, there's a surprising amount of liquidity still available. I haven't had that much trouble getting equity. Bank financing, the multiples are coming down a bit. Banks are being a little bit more cautious. But I've been surprised that financing still seems to be there. And Ty, I see you nodding. Maybe you could tell us about in Israel how liquidity's been in financing.
Yeah, so financing, it's a bit of a mixed bag. We're basically seeing VCs in Israel are quite active, but more at a later stage, and definitely much more focused on their portfolio companies rather than looking for new investments. But having said that, I mean, here and there you do see proper classic VC rounds like we did before. We're seeing much more use of debt instruments and safes. You know, West Coast style. There's a lot of those rounds, but there's a significant drop in kind of early stage investment. You know, Series A, B in tech.
Interesting. Jonathan, Peter, do you want to speak to financing?
Well, I actually think that the picture is very similar in the UK. There's a lot of funds here which have got, as I mentioned previously, there's a lot of capital in those funds which needs to be deployed. Some of those funds from Apollo, Endless, who are concentrating on the opportunity or value space. So there's a lot of opportunities there. I think that when you look at the value, the deal values in the UK, I did do a bit of research from the Office of National Statistics here in the UK. I think deal values in the first quarter of 2020 increased tremendously, but the number of deals reduced. So this is before the impact of COVID.
Right.
And I think that we're looking, obviously, that we've fallen off a cliff. So those funds that didn't deploy in that time have still got the cash. The banks are still willing to lend. They're a little more reluctant to do so in a short space of time, but they are spending more time on their due diligence and getting under the bonnet of whichever target that is being considered.
So I would say, you know, the upper Midwest of the United States is notoriously conservative. So I think lenders here, though they have the capability, are taking their time, waiting to see how this ships plays out. I think they want to see 1 or 2 good months before they'll jump in and do something. So I think there's going to, and I think, you know, the other thing they're waiting to see is that, you know, many of their borrowers are participants in the stimulus loan programs called PPP loans here in the U.S. And once those funds get exhausted, will there be covenant violations? Will there be other issues that's going to drive concerns for the banks as well? So I think here we're probably a little bit more conservative than even other parts of the United States. Not different than maybe in the past, where maybe there wasn't funds available. I think there are. They're just not ready to deploy them yet fully, but they won't. But at this point, I think it's a very conservative approach.
Pete, is it the case that banks? Sorry, Chris. Is it the case that banks and other funds are focusing more internally than externally, obviously as a result of COVID, or do you see that the investments that Itai was looking at, where a lot of them are US-based funds making investments into Israeli companies, do you think that is likely to continue in the short term?
My sense is, this is the sense that it's more of an internal look. and that the next time. That's what they're focused on right now. That may change. That's a sense that I have.
So let me speak momentarily on a niche group of private equity investors who are very bullish on the current circumstance. In search funds, and we have 30 or 40 of those getting formed a year in the United States looking for acquisitions, and they're doing acquisitions in the lower mid-market. But those investors, we had a webinar like this about a month ago. They are absolutely, quite frankly, thrilled with this environment other than what's happening to the world economy. But from the perspective of making money, they think this is going to be a tremendous opportunity. They see this as going back to the days of 2010, 11, 12, when multiples were much more rational, and they're eager to deploy capital. So I suspect they represent a group of investors out there. They're in the lower mid-market and mid-market who will think that way. And there tends to be, at least in the United States and with the companies I work with, less leverage in the lower mid-market, and they're capable of withstanding shocks like this. So what I have seen just even in the last couple of weeks is the engine's starting to move again. Obviously, all the effects we've all been speaking about have been my experience as well. But nevertheless, I'm seeing some positive things. So I was trying to be a bit positive there, everyone, and truthful at the same time. I don't disagree with anything that's been said so far, but that is an aggressive opinion, and there's a meaningful group of equity investors out there with that opinion. I want to move on to another question. This is from Michael Locke. From Norris McLaughlin in New Jersey. It's an interesting question, and I hadn't really given this any thought. It's a variation on structure, quite frankly. Does anyone have any thoughts about whether they anticipate or have seen greater joint venture activity rather than strategic acquisitions as another way of effectively approaching growth and acquisitions, but not doing it directly through strategic acquisitions? Do you anticipate there being additional joint venture activity as a way of dealing with the COVID environment? Anyone have any thoughts on that? No one's picking up that basketball. I think it's an interesting idea, and I think it's likely, but go ahead, please. It's Ty. Yeah.
I was just going to say, I mean, I have seen joint venture type structures during Corona that have come across my desk, but I don't think it's any different to these type of deals that would have happened pre-Corona. I think it was more because of strategic reasons, tax reasons, and also a multitude of factors that are not necessarily related to Corona. So at least from my perspective, no, I don't think it's making any difference. It makes any change.
Jonathan, did you want to speak to that? Yeah, please.
Yeah, I think there has been a little bit of movement certainly on the real estate side, where companies are looking at joint venturing with one another for some of the development activity that they've got ongoing. I think in the overall M&A sphere that we normally work in, which is the same as you in the mid-market levels, I think it's not really having an impact at the moment because it's a little early in the overall scheme to actually see that. I mean, Pete did. I go back to the same point that Pete made before about partnerships, about sellers and buyers actually doing deals together so that they can, so that they don't need to pay out everything up front, so that there's the earn-out basis or deferred income coming, so that you've got building of an overall business where you've got the parties remaining. It's hardly, it's obviously for a carve out. If you've got a corporate carve out, that's not appropriate. But for a business that is ongoing, that is completely separate, I think it is something which you can look at sensibly.
I think it is a good question too. I do think it's a good question, but I agree. I have not seen more in true joint ventures, but I do think some of the structures that we're seeing mimic joint ventures, and that if you have a rollover of 20,
Yeah,
25%,
that's interesting.
that's getting started more akin to a joint venture even more. So I do think those concepts are being baked into deals, but I haven't seen the true, true joint ventures in the past, but that could change. But that was a very good question.
I think it's an excellent question, and quite frankly, it gives me another way to think about transactions. So I appreciate that question. Let's, if you don't mind, panel, let's dig into the transaction documents a bit. Let's drill down a bit and get a little more granular. And perhaps on diligence and reps and warranties, I could ask some specific questions if you like, but Peter, would you like to kick us off on what some of the things you're thinking about when you're thinking about transaction and diligence you're particularly concerned about that you wouldn't have been concerned about several months ago? Perhaps things you're thinking about doing in reps and warranties section of the purchase agreement. If you have any ideas, tips, or thoughts there, I think that'd be great.
Yeah, with the whole risk allocation that's inherent in every transaction, right, between the buyer and seller, and that's shifting here. And part of that is the due diligence that's done before that's incorporated. But I'm expecting a few things. One, on the due diligence side, it could be a real nightmare in terms of reviewing contracts for forced majeure provisions, and if the target is one that has a lot of negotiated contracts as opposed to form contracts. And so that's going to be a due diligence issue. And again, whether you're a customer or supplier, and looking at what happens if we see another wave here, how will this play out? What protection does it address? A pandemic? Does it address a second wave? Does it address curfews and so forth? How a provision that frankly a lot of people didn't pay a lot of attention to generally in these type of situations. So that's going to increase a little bit, I think. I also think that reps and warranties about any of these stimulus loans, due diligence regarding that. There could be some, the forgiveness aspect of the timing, and you've been on top of this as much as anyone. You know that the guidance we've gotten from the government on these loans has been haphazard at best, inconsistent. Lately, it's been more pro-borrower, but there are still concerns. And lately, they added a 24-week sort of forgiveness period. But what that complicates things in the deal context, because in an asset deal, what does that mean for a borrower who hasn't completed the 24-week period and trying to satisfy the conditions to get the loan forgiveness and the stock deal? I can see some borrowers as a condition forcing that to be repaid. That's going to cause an issue on the front end. So I think those types of provisions are going to, in this market, will have greater play. And then I also just think generally on survival period and baskets and caps, that those are all going to be more pro buyer. So I think the caps will be higher, baskets will be lower, and you'll probably see more first dollar baskets as opposed to a deductible basket. And then I think you'll see more exclusions to both too, things that are not subject to a basket or a cap, and then maybe exclusions of some of the general survival periods will be pushed as well, because buyers are going to sense, and rightfully so in many instances, they have more leverage. The pendulum's going to swing back on some of these provisions. And we'll see them maybe mimic what we saw back in 08 and 09, if not more so.
Thanks, Peter. Ty?
Yeah, I mean, everything Pete said, I mean, like one for one applies here, 100%. I would just add stuff that has popped up in due diligence exercises we've had recently is all the stuff around working from home, and kind of there's all sorts of employment related issues, regulatory issues around working from home and salaries. And we had one particular case now just a couple of weeks ago with a company that was cut back in salaries, sent the employees to work from home on a part-time basis, but they in practice worked full-time. And so there was some sort of there was exposure to claims from the employees. So that sort of stuff is definitely coming up. We're focusing much more on termination clauses in agreements, in commercial agreements the target companies are contracting, seeing how easy or difficult it is, depending on the situation, to get out of these agreements. And again, force majeure, I'll just re-emphasize just how important what Pete said. I mean, really critical issue for companies, whether we refer to the COVID-19 impact or not, and how we refer to the COVID-19 impact, and whether we hedge the impact, and we say not above a certain amount or not below a certain amount, or just kind of keep it completely open. And I think, also around office leases. So that's been a particular issue in Israel. So companies have been looking to reduce office space, and then the question was, whether they could get the landlords to agree to reduce the rent, whether they could subcontract some of the space or not, and that's raised a whole load of a range of issues. It's only been discussed in court a couple of times during the crisis, and both times the courts have been very hesitant to allow the lessees to fiddle around with the contracts and to drop rates or to kind of get out of the clause, to get out of the agreements. So this sort of stuff has come out in diligence and has impacted indemnity clauses as a result.
Jonathan, would you like to speak to this issue, or you think we've covered it?
I think we have covered most of it. I think the only issues, there's only sort of 2 or 3 issues, Chris, that I could add after the shopping lists that came from Pete and Itai, which I think are very similar in the UK. So we're all on the same basis of the diligence that we're doing. So increasing diligence in those areas, increasing diligence on data protection issues, obviously with GDPR compliance and the fact that people are working from home, and therefore you've got to make sure that your IT systems are more complex, that the compliance is there, and I think that's definitely an area for more development. The other two areas that I would mention, one that I was thinking about, which was that obviously if you're doing a global deal or doing a deal across multiple jurisdictions, then the impact that you really need to be thinking about as to the impact of COVID in each of those jurisdictions, that needs to be thought through, because the impact is very different. So the impact now in the US, where you're sitting in your office, I'm sitting at home, Itai is in Israel sitting in his office, and likewise Pete. But the fact is that people are going to be in different places, different times, and the way that this virus has moved across the globe, it can just as very easily move the other way. So that's one area. And then the third area that I would mention that nobody else has is the competition issues. Competition, I think, is going to change very much certainly in the next 6 to 12 months, where you've had already indications in the US, more use of CFIUS, more reviews through through that mechanism, defense protection, but not only defense, pharma, healthcare have all been pulled into that sort of scenario. And I think there's going to be more of a similar move in Europe, Middle East, and elsewhere, where people are basically trying to change their antitrust or competition policies to move to protect more through the local and regional champions and try to keep out some of the others. I'm not going to make this an anti-Chinese point, because it's not. It really shouldn't be there. I think there has been a move in certain countries to move away from Chinese investment, but I don't think it's solely Chinese. I do think that people are thinking very much for themselves. States are thinking for themselves. The US I don't think is any exception to that.
So what I would add to what the panelists discussed is a little bit of a broader perspective on how I'm thinking about transactions. One, we get very used to our own documents. Don't walk into a deal with your own documents thinking you know what's going on in your documents. If your documents are like mine, your primary purchase agreement is 60 to 80 pages probably, right, typically. And we've gotten very instinctive about what that document does, accomplishes, and doesn't accomplish. And you're going to have to read that document. So if you're a senior lawyer out there and you're used to being a little hands-off because you don't need to be deep in your document, you know what? Read the document start to finish before this next transaction you're doing, because you're almost assuredly going to find a few impacts that you just weren't even thinking about. That would be number one. Particularly reps and warranties. I wouldn't be that confident that your reps and warranties that have served you so well in the last 10 years of your practice are going to serve you quite as well in this environment. They'll do okay, but there's probably, again, some unforeseen consequences and some needs in there from a diligence perspective. Also, I would think about COVID in three ways with any business. What effect is COVID having, if you're a buyer, on the customers of the business you're buying? So what effect is it having on the sales? I would think through that. I think through very carefully, and we've already talked about to some extent, what effect did COVID have on the business? And we talked about IT systems, and regulatory issues with employment, data privacy. In the US, we're not as careful about data privacy unless you're in California, quite frankly. It's just not as high on our awareness spectrum. And you know what? I think you really ought to be paying attention to it in a way you didn't before, because so many people are working at home. So it's not just, and then governmental programs. And what effect, Peter talked about this a bit. There's no question that any acquisition done over the next few months is going to have to think very carefully about PPP, that government stimulus package, and who has the right, how it's going to get collected, because that ultimately is an equity injection if we get forgiven for that, right? And you're going to have to be confident that that's there, or who is going to exercise this right if something goes wrong to collect the money and obtain forgiveness. So those are all things to think about. Let me move on to another question we had. So here's a question, and it has to do with respect to earnout clauses and transactions, as I understand it, that were signed up prior to the pandemic breakout. And the question really is, have you seen any relief from buyers and sellers that closed deals before COVID on earnout clauses? In other words, you had a pre-COVID earnout clause, and now COVID has caused quite a problem with the earnout clause in the sense that it's going to be more difficult to achieve that earnout. I don't personally expect there to be much relief coming from buyers. I think people are going to stay with the deal they made unless there's some leverage on the part of sellers to renegotiate there. But has anyone given that any thought? It's not something I've given a lot of thought to.
Oh, sorry. Pete, go ahead, or whoever.
I was just going to say, I agree with you. I don't think we'll see a lot of that. I have seen an instance once where someone, the goodness of their heart, thought, it was a situation where so close to reaching the thresholds and wanted to make sure that they kept a key employee happy going forwards. Wanted to make sure that as the former owner didn't want to do anything that would cause them to be disgruntled, so they bridged the gap. That was one that was a cliff, as opposed to some that are scaled. So the cliffs might be the ones you see, but I agree with you. Generally, I don't expect to see it, but I have seen it once.
Yeah, I just add that I agree with both of you. I don't expect there to be any relief, and I can substantiated with a personal example of a deal that I helped close in February, just prior to Corona. We closed it, and there it was a large, in Israeli terms, it was a large M&A transaction where about 50% of the consideration was in earnouts and based on performance. And I'm in touch with them daily, and there's no change.
Right.
There's no change.
Right.
Yeah, I don't think it's any different here in the UK.
So I'm aware we're at the top of the hour. I had a feeling, quite frankly, that we would have more questions, and I see that almost all of our attendees are still with us. So just for the attendees, if you want to drop off, certainly feel free to. But I know the panelists, we're going to go for a bit longer, handle a few more questions. And if you would like to continue to participate, we would love to have you continue to participate, because we've had great participation today and a large number of attendees. Can we move on to rep and warranty insurance and what changes in the use of rep and warranty insurance? Has anyone seen any changes in the actual contract and what's coming from the insurer? And Jonathan, I think you had some things to say about this. I think you have had some experience with rep and warranty insurance over the last couple months.
Yeah, look, I think, thanks, Chris. I think the development of rep and warranty insurance within the UK market has been ongoing since probably around about the early 2000s. So you had at the very beginning of the market, a market where you didn't have huge participation of the insurers. You had a few brokers who were interested in the market, but what you didn't have was the market which you now have today. You have substantial numbers of insurers who are willing to actually book insurance for deals. Now, those insurance for the rep and warranty, or the warranty and indemnity insurance as it's known in the UK, has had various iterations. There have been recently more policies put in place to cover tax insurance and contingent risk insurance. Now, contingent risk insurance is the sort of risk insurance that you would really want in cases where you've got COVID. So you've got issues where a synthetic warranty package or synthetic warranties are actually created between the insurer and the buyer, so that the buyer can get protection on areas that are not otherwise going to be given by the sellers. Those policies have increased over the years, particularly in the last 6 to 12 months. And what I understand, because obviously key to all of this is the premium and how long it takes to actually deliver that policy. So most insurers are saying they can actually write or underwrite the insurance policy within a very short period. The shortest period of a synthetic warranty insurance is 3 days. The longest is probably more than a month or so. So you are looking probably at a week to 2 weeks max. You're looking at insurance policies and premia where it's around about 1% now, something between 1% and for synthetics. That's on the basis that you have a de minimis of around about 0.1%, and you have an overall retention of around about 5%. So those are rough figures that I've picked up in the market. I think the tax risk type policies, you're looking at between 2 and 6% premium. So it's slightly higher than the synthetic ones. They're also developing policies to cover distressed sales. So that's a very interesting area where obviously where you've got a distressed sale, you are not going to get protection, whether it be from the administrator or liquidator in an insolvent situation, or necessarily from sellers, who are selling out and don't really want to be on the hook for millions of pounds of warranty clearance. And so they are developing policies to cover that scenario as well.
That was terrific, Jonathan. And you have always been, of the, at least in my experience of the four of us, known as much about rep and warranty insurance as anyone. So Ty or Peter, do you have anything to add to that?
Yeah, just a little bit. No real world examples yet, but in talking to people, some expectations of what we're going to see here in this market. You know, rep and warranty insurance have become so much more common, deals large and small in the U.S. You know, much no longer cost prohibitive in even smaller deals. But I do expect, I think others do too, that there'll be more claims made against the insurance. Premiums are going to go up, and you're going to see more exclusions to coverage. And so landscape will change. You know, one benefit of having the rep and warranty insurance in place is that, you know, sellers took more, and by design, a laissez-faire approach to comments on the reps and warranties. That'll change if there are going to be more exclusions, and you'll have to negotiate those more traditionally than maybe you had in the past. So I do expect some change there, but I haven't seen it yet.
Okay. Maybe a thought for the panel, and I'll be happy to lead off, but maybe what we should do is go around the horn, and you could raise anything that you think is particularly valuable that we haven't discussed so far, particular point or two, and I'll give you 2 examples. One suggestion is, if I were in the deal environment we're in now, I would think very hard about putting in a sandbagging provision for any buyer. Basically accepting out anything that they know that may be COVID-19 related, that for some reason we haven't disclosed or should have properly disclosed if we were thinking more broadly. And I'm not a big fan of sandbagging provisions. I think you're generally responsible for your own reps and warranties. But in this new environment, and since we haven't had that many cycles in a COVID environment, I give some thought to accepting out any knowledge the buyers have that is COVID-19 or regulatory related from bringing a claim later. The other thing I'd suggest is that I think, at least in the US, particularly as we see more and more structure and we see formulaic issues that are likely to be disputed, because there's no question that earnouts, working capital targets are often disputed. The disputes, though, tend to be fairly straightforward, economic, often can be resolved by an accountant, often not best resolved in front of a jury. So I would give some thought, if you don't regularly use accountants, if you don't regularly use mediation or arbitration to address disputes that are structure related, I might be more inclined to do that in this environment, because you're going to get a faster result if you draft your provisions properly, and speed to an answer and keeping some of those complex structure related issues in front of experts is likely to serve you better, in my opinion. But other people may want to comment. Those are just some thoughts. And Peter, is there anything you'd like to bring up for the group?
Yeah, I want to follow up on a couple of things you said. Really good points and interesting ones regarding the, you know, the anti-sandbagging knowledge. And my thought is the anti-sandbagging, that I think it's tough. I mean, I'd be concerned for a buyer and a seller that somehow knowledge is going to get imputed to them because of the world we live in now. Of course they knew about this, because I would be hesitant to want to grant, you know, I wouldn't want constructive knowledge and a knowledge qualifier. I would try to stay away from that. And I'd be willing to give up an anti-sandbagging provision if I got a non-reliance of reps and warranties outside of the agreement. You know, just stick to the 4 corners of the agreement, and let's not bring in anything extrinsic. I'm happy doing that if it goes both ways and not one way. I think that is kind of the death sentence for a claim. You know, the claim they have knowledge is all or nothing. It can really be a tough one to get through. It's a tough one for, I think, sellers to accept sometimes if a buyer knew about it. I think practically it doesn't occur too often that a buyer knew something, the seller did not. You know, that does happen once in a while. And I have some buyers who are great on due diligence and will learn some things that sellers were completely unaware of. But most times I don't think that's the case. But I do know that sellers often have a hard time accepting that provision in theory, that if the buyer knew something was inaccurate, why should they be allowed to recover, even though most states will allow that. Not all. I mean, certainly not unanimity on that in the states, but certainly I think most will allow that. But so I think that's a very good point, and we'll see. I'm curious to see how that develops over time in some of these negotiations. Now, if buyers indeed have more leverage, then they may obviously be able to push back on that. But it's an interesting point there as well.
Good time.
The other thing I would say that you mentioned the mediation point that I've had, I agree with you. It's quicker. The one caution that I would have is I've seen buyers, when this is done before, try to recharacterize a breach of rep and warranty claim as a purchase price adjustment so they can avoid the deductible. And I don't want an accountant deciding a breach of a rep and warranty claim. So the language has got to be, I think you need to really specify in there that they're dealing with purchase price adjustment issues and accounting issues and not breaches. That would be my concern about that.
I think it's a really good point. Thanks, Peter. Yeah, that's a good addition there. Yeah. Itai?
Yeah, so just in response to the issues you raised, so on the sandbagging in Israel, it's less. You see these provisions much less often, if at all. That there is a requirement by law to act in good faith, and that's usually the way we would attack this if we put a court around something the buyer was aware of. So that's on the sandbagging. Mediation. We're kind of a hot-blooded Middle Eastern country. We're kind of less, the parties less inclined to try to settle disputes amicably, and court seems to still be the primary route. Arbitration less so because it's expensive, and courts are usually the main route to go. Just a couple of things that I just wrote down that I've stumbled across, and I had big issues around during Corona, and I guess it's around distress deals more than kind of regular M&A transactions. It was around, and again, kind of more specific to technology-related companies, and where they're structured is waterfall issues. So, we have companies with complex shareholding structures, with complex preferences on liquidation preferences, and then when we get to M&A deals at these low valuations and low consideration, that's really, really difficult issues. And we're finding that shareholders are willing to negotiate on what they've had. They're willing to open up their preference, kind of figure out some sort of a gentler, a softer preference in order to be able to get the deal done. Because of the concern during Corona, if they don't get it done, then the company might completely fall flat. So we've seen that, and also investment banking commissions. I've a couple of disputes around that in M&A deals, where the commissions are still kind of based on pre-Corona times, and the numbers are completely crazy and not necessarily proportionate to the price of the deals, and it's become an issue. So kind of my advice there, in as much as possible, is to try to address this issue in advance and not wait till the last minute and kind of have that as the last thing that needs to be closed in order to close a deal, because that can get really messy.
So Itai, I'm having a hard time reconciling this hot-blooded, litigious Itai with the person I met sending, I think, teddy bears back to his children several years ago. I think that's where I met you. For those of you who are on, Ty is a wonderful father, and whenever he travels, he sends his children back presents. And that's how I met Ty, in a FedEx room, effectively.
Exactly.
So the litigious mailer of children's gifts. It's wonderful. Jonathan, would you like to speak?
Yeah, sure. As far as the anti-sandbagging, I just deal with your 2 points, Chris. I think that in the UK it's slightly different. I think you need to look at the specific terms of the relevant contracts. So I agree with you. One of the things that we need to do as a lawyer acting on these deals is understand your contract, or go back to actually read your contract in the context of COVID-19. So that is a very important piece of advice which you did give. As far as amongst the many pieces of advice that you've given this afternoon, as far as the sandbagging, is concerned, if you have,
almost fell over.
If you have actual knowledge as a buyer of a breach of contract, of a breach of warranty within the contract, then you have a problem, because there have been a significant number of cases in recent years, starting with a case called, I think, Infinite Land, of a little while ago, where you cannot rely upon the exclusion to say that you can exclude the actual knowledge of the buyer from a potential claim. So the buyer can't rely on ignoring its due diligence, ignoring its knowledge when it comes to make that claim. But you need to look at the specific wording in the relevant contract. That's the first thing. The second thing, on mediation, I think it's probably unlikely that we are going to go down the route of mediation on contracts here in the UK. We have a substantial body of law and a substantial approach in the way that we've used the court system in the UK, that people are comfortable with it. That's why when you write contracts, whether it be in Russia or elsewhere, they choose English law, and more often than not, they still decide to litigate through English courts. They don't necessarily go on the arbitration route. There has been a move towards arbitration a little bit over the last 5 to 10 years, and there is a group who are trying to seek to do that more so than others, such as on the infrastructure deals. But on the general M&A, it's not an approach that people usually take. I'd like to mention just one other very quick point. So the point that I made when we were discussing this previously was that a lot of these deals get signed up over a long period of time, and it takes time to get there. It's going to take even longer with all the due diligence that we've all been discussing that needs to be done, a lot more. So I think there's going to be more of a push towards options being signed up, and with a break fee attached to it, to give people the opportunity, to give a buyer the opportunity to get a real hard look at the underlying asset that they're acquiring. Clearly, that's not going to be the case where we've got a distressed deal, but in the solvent deals, I think this may be used more so than it has done previously.
I think that's a fascinating comment, Jonathan. I had given that zero thought, and I'm going to keep that in mind for my transactions. So that's a very interesting possibility. It's certainly a tool that I've never used really in this context, and certainly could. So that's terrific. Unless someone raises their hand on the panel and says, I have something that I very much want to share with the group, I think we'll wind it up here. We've gone a bit over time, and I appreciate the time that everyone's devoted, Peter and Ty and Jonathan, to this panel. Terrific discussion. I enjoyed it. I learned a lot, and thanks so much. And Meritas, and particularly Crystal, who put in quite a bit of time getting this together and helping 4 lawyers figure out how to use the webinar functionality. We gave her some scary moments, and certainly probably caused some gray hairs at an early age with poor Crystal, but in any event, thank you, Crystal. And thank you everyone for joining. It was great. I really enjoyed it, and I learned a lot. Thank you.
Thank you, guys.
Thank you.
Thank you, Chris.
Thanks.
Thank you. Thank you, everybody.
Thanks.
I just want to say something really quick before we close out, that just a reminder that in the next few days, I'll distribute a copy of the recording as well as everyone's contact details. Please do not hesitate to reach out to one of these four if you have a question and would like to have something answered. Also, please don't hesitate to share the recording with somebody else who might find it of interest. Whether you're a Meritas member or a client, go ahead and please share it widely. And with that, thank you again, everybody, for joining us. Thank you, group, for sharing. That was wonderful. And I hope everyone has a really great day. Bye.
Thank you.
Take care, everyone. Be well.
Thanks. Bye.
Bye.